So when we think about buying a business and going from active searcher, I'd like you to meet. I'd like you to meet Alex. So Alex was an aspiring entrepreneur. He wanted to buy a business, but didn't know how to focus his search, build credibility, or structure a deal lenders would support. Um, he asked a mentor, "How do I narrow down the right industries? What makes a seller trust a first-time buyer? And how do I position my deal so banks will fund it?" Alex, a first time buyer, searched for a year but struggled to narrow his focus, gain seller trust, and structure a fundable deal. So, for those of you actively searching, Alex's story is very likely similar to something you've experienced. The there are ups and downs in business acquisition searching. So stories like Alex make it helpful to know that you're not alone. There are other people, first-time buyers, who are going through some of the pain points you are as you continue this search. So the question is, what do you do next? How do you go from active searcher to business owner? I always like to use the phrase to stop planning and start doing. Stop planning about your business search, putting together the perfect CRM, email outreach campaign, and start doing. And the reason why I've coined this phrase is throughout, you need deal reps and you need to go through the motions in order to refine the process that works for you. There's hundreds of different ways to buy a business and speak with brokers and complete a successful sale, but there is not a one size fits all. It's really you, the searcher, who needs to select a path that makes sense for you personally. So don't wait for that perfect plan. Just start moving forward. Make that first call, send that first email to a broker. Um, Network and build connections early. Join, look for peer groups in and around your local township. Uh, there might be acquisition entrepreneur groups you can join, which have first-time searchers. Community is often helpful where you can leverage resources appropriately. I'm from the Washington, D.C. area, and I attend a monthly meetup of prospective business searchers. It's an hour or two Wednesday evenings, and it's very beneficial because you get in a room of 30 or 50 folks who are just like you. They're trying to buy a business, and you can bounce ideas off each other, talk about best practices in just a informal environment in person. So if you're stuck behind your computer, I would encourage you to break out of your shell and build some of these connections in real life, whether it's by attending some of the boot camps or looking for free options in your local community. If you're around the Washington, D.C. area, I'd be happy to introduce you to the one that I attend. So feel free to reach out to me after the webinar. One more point on the start planning and stop doing is to avoid this idea of the analysis paralysis trap. The analysis paralysis trap is something that looks like this. You receive a LOI, you receive a SIM from a business broker of a business you really like. You read through the SIM, you get really excited. The numbers are jiving with your business buy box of the type ideal business you'd like to buy. It's in the perfect region. It checks all of your buy boxes, but you don't follow up with it. You sit on it for a few days, maybe a few weeks, and then you finally get the courage to reach back out to the broker and express interest. This is a perfect example of an analysis paralysis trap. The broker is likely to say one of two things. One, thanks, but the business is no longer available. It's already under contract because someone moved faster than you. Or two, Sure, the business is still available. How would you like to proceed? In my experience, very good business listings move quickly. So if a business listing from a broker or someone you come across checks all your boxes, I encourage you to move with your next steps within a few days. Yes, it's scary, but you have a lot of time during due diligence to work slowly through the process. I always say the best deals and the best deal strategy is to know when to move fast and more importantly, know when to slow down. When you should move fast is when you see business listings that check your buy boxes. Move through administrative items quickly and allow yourself more time to move slow during due diligence, during complicated conversations around working capital, etc. But don't get caught up in the administrative side of deal making because it won't leave yourself enough time to slow down on the things that really matter. So we've started to do, we've taken that next step into planning. How do we structure some of these deals? So when we're thinking about structuring SMB deals, there's two primary types. There's an asset purchase or a stock purchase. I break down each of these topics in depth in separate webinars, but at a high level, an asset purchase, you're acquiring the specific business assets of the company. In a stock sale, you effectively are buying the stock of the entity, assets, liabilities, etc., and the business entity is just changing hands. Uh, st stock purchases have favorable terms for sellers from a tax side of things. Uh, Asset purchases are more favorable from a tax standpoint for buyers. So if sellers are listing their businesses as a stock sale, it's because they're trying to take advantage of some of those specific tax benefits. I break down both of these benefits and more on my channel in the asset versus stock sale webinar, so I encourage you to check that out. So what's the process of a business acquisition and what are some of the resources look like? So here's a five-step sort of walkthrough of how we get there. It first starts with identifying opportunities, exploring platforms, some of the marketplaces which list these businesses. Things like BizBuySell, Acquire.com. Maybe there's some off-market deal sourcing you can do your own research with. Search Funder is a community of acquisition entrepreneurs, service providers, bankers, etc., which sort of all live in this ecosystem of small business acquisition land. I encourage you to check that out. Um, from there, you make this initial contact. So you reach out to sellers, reaching out to brokers, asking them if they have businesses for sale. Uh, I like to emphasize this initial contact. It's very important in the process. And the reason is you're establishing yourself as a credible business buyer, which sellers should take seriously and brokers should take seriously. Uh, think of this initial contact as a job interview. If you reached out about a job you were looking to apply for, you would present yourself in a professional manner. Think of that the same way when you're speaking to these sellers or brokers. Serious prospective buyers typically will close on transactions because they're taken seriously. Those who seem more like tire kickers will struggle through the process. So I encourage you just to approach this in a professional manner. From there, you're going to tick through things like negotiating the LOI, structuring your offer, and putting together, that LOI term sheet, which shows how much you want to buy the business for. Is it an asset or a stock sale? And what are some of the other terms of your bid for the business you'd like to purchase? From there, you're going to move into due diligence, which contains legal, financial, operational, and tax. Assuming those boxes check out, you're going to then close the deal and finalize the acquisition process through the purchase agreement. So, what does a typical timeline look like? Picture this. You've just signed an LOI and you send it off to the sellers. You may have compiled this letter of intent or LOI yourself or used a lawyer. You're crossing your fingers, and the seller and broker reply back with a signed signature. This is great news. You have secured an LOI and you are 90 days away from finalizing your business purchase. The first question I'm often asked when I speak to those of you, those in this position is, what do I do next? There's a lot of things you could do, but what are the things you must do? Once you have a signed LOI, you need to assemble your deal team. It's best practice to assemble this a week or 2 weeks beforehand, but if you haven't yet, you still have time. Don't worry. You need to quickly assemble a deal team which contains an M&A attorney, a loan broker if you want to secure SBA loan or a private loan and want to use one of the services, which most of the time are free. And you want to engage some sort of quality of earnings or financial due diligence provider who's a licensed CPA to analyze the business and verify the earnings of the company. Once you assemble your deal team, your financial due diligence provider begins their process immediately. Typically, I like to be engaged within 1 to 3 days of your signed LOI, and we can start our diligence process within 24 or 48 hours. The reason why starting out with financial diligence is most important is because you've submitted a bid based on financial information which is largely unverified. The reason it's largely unverified is because these financial data was prepared by the broker and it hasn't been vetted for accuracy. The only way to do this is to generate financial data from the accounting system and conduct a detailed analysis to confirm the revenue, expenses, and net income of the business are what they say they are compared to what was in your bid. More often than not, a sim or marketing materials is a fancy slide deck, but you need to get underneath the hood and examine what are the components of revenue? What are the components of the expenses? And ultimately, what does that relate to as net income? The net income or the cash flow of the business is absolutely vital because it's going to tell you if this business can support an SBA or a bank loan. The real cash needs of the business is one question that every financial due diligence provider should give you. And with that clarity, you can have confidence that this business can support this bank loan. From there, you'll kick off things like tax, legal, and move through that closing process. So if you just signed an LOI or would like to take a screenshot of this roadmap, feel free to do so now. So I'd love to hear from you all, if you're still with me in the comments, what do you think is the biggest challenge of why deals die? So if you want to go launch that polling question, that would be helpful. So why do deals die? Is it because of lack of financing, um, changes in working capital? What do you think is the number one factor of reasons deals fall apart in the last week before closing? If you want to take a minute and respond to that, I'd appreciate it. All right, we can go ahead and close that out. So there's a lot of reasons why deals fall apart in the last week. Things I've seen, and I've worked on hundreds of transactions. Things like disagreement and working capital between the sellers and buyers are a big thing. I've seen many sellers get cold feet, which from an empathetic side of things is understandable, but it's very frustrating from a buyer side after you spent months on a deal just to have the seller get cold feet. So I put together a toolkit called the Business Buyers Toolkit, which is some of my best template. Um, it has the financial due diligence checklist. It has my process I use on every deal. It is up to 92 pages as of the last few weeks on the latest edition. If you want to download your free copy today, feel free to scan that QR code. Uh, it's some of my best material, so I do, if you find it useful, I'd love for you to reach back out and tell me what's the best part of the toolkit. So we've assembled the experts. We have thought about the timeline. Now, let's get to the turning point of Alex's strategic pivot. So if we think back to our story, uh, the turning point in Alex's journey was he began to build credibility. He created a comprehensive buyer profile, which he shared with brokers and sellers. This buyer credibility outlined his background funding, his operational experience. And this was building this credibility allowed him to begin to conduct this outreach to brokers. And a lot of these brokers and sellers began to reach back out and say hi. Um, Alex clarified his business criteria. So he narrowed down his search to focus on service-based businesses with recurring revenue and a strong local presence. If we think back to when we first introduced Alex, he was this very energetic prospective business buyer, but he wasn't presenting himself in a credible manner. He wasn't clear on the types of businesses he wanted to purchase, and his strategy was just not working. If we go to the next slide, so Alex found the right support network, and um, Alex found the right support network, and through that, he was able to engage lenders early on. He learned about LOI structuring and began drafting integration plans before closing to show that he had serious preparation in his search. So this is the pivot that I talk about. And when I speak with buyers and will work with them, I highlight a lot of these things where you take the next step from prospective business buyer to serious business buyer who will close a business. And here's why. Uh, by clarifying your criteria and narrowing your search, you can quickly move through target transactions in a much easier basis. So, what are some smart, what are some smart buyer priorities? And let's take a look at, picture this. You've uncovered a deal you'd like to submit a bid on. What are your priorities from a buyer standpoint? The first question you need to ask yourself is the revenue real? Then you need to move to things like expense analysis. Understand what are the components of expenses? What is the true cash flow of the business? Balance sheet reality. What are you actually buying? Does the business have a balance sheet? Is it asset heavy? Are there no assets is it an asset light business? Understanding these four boxes is critical when you're doing not only quick analysis, but detailed analysis. So if you're a prospective business buyer and you're kind of overwhelmed with analysis, I would recommend focusing on these four buckets. And if I were to narrow it down to two areas, I would focus on the cash flow. So understanding what's the actual cash flow and cash needs of the business, and what does revenue and expenses look like on a monthly, yearly, 5-year period. These three quick benchmarks in your quick analysis will allow you to digest information faster and make decisions about if this is worth a second look in a quicker and more effective manner. So let's double click on the purchase agreement. So the purchase agreement is typically compiled from an M&A attorney, and these are some of the components. So your purchase agreement is your living document, which is your binding agreement, which effectively gives you ownership of the company. The purchase agreement will contain things like a target working capital. It might include things like a holdback amount of escrow. It may also include a true-up period to define post-closing adjustments and a collar. Uh, this slide speaks to the net working capital target of the paragraph in your purchase agreement. So when you think about this slide, this should really say purchase agreement dash working capital section. These are the components of what working capital look like. So what are some of the common pitfalls of business buying? So I've worked with hundreds of searchers. Here are some common pitfalls I've seen across the board. Buyers ignore due diligence findings, and they have a bias to look the other way. So the question is, what does this actually look like? I'll give you one example. On a recent deal, I was looking at the business expenses of the company, and in the sim, they were showing monthly expenses of about $100,000. It was a smaller type business. When we compared what was presented in the sim, which was showing about 100,000 of monthly expenses, and we generated reports in the accounting software, in QuickBooks in this case, the picture was a little bit different. The picture included 100 and 220,000 of expenses. There were a few employees who were not included in that number, but they were on the payroll. And when we asked the question about it, the broker said that those individual costs, those salary costs, were not included in the sim because those employees are not expected to continue with the transaction going forward. So this is a material finding in due diligence, which unfortunately it comes up quite frequently. There is a difference between the profitability in the sim and the real profitability from the accounting system of what the business is actually producing. The common pitfall is a buyer, a prospective client, prospective business buyer may try to justify why this is okay, and they'll be able to work through it. Um, the real challenge is the following. The business effectively needs to produce $100,000 of more cash flow to be the same type of business as presented in the sim. These employees who were leaving and excluded from expenses will need to be either retained by the company following close, or the new business buyer will need to hire new people to fill their roles. Effectively, the answer is the same. The business profitability is materially different than what was presented in the sim. And the question is this something you can work through in a deal, or is this something that is a deal killer? So that's a common pitfall and something I see quite frequently. So I challenge you as the buyer, if you do surround yourself with a competent deal team, listen to some of the things they flag during due diligence and ask yourself the question, is this enough? Are we able to overcome this from a deal standpoint, or do I need to reconsider if this business purchase makes sense? So if you have any questions as we're ticking through this, feel free to write in the chat. If you're currently working through a topic or have questions about the deal process, I'd be happy to answer them. So, well, let's check back in with Alex and see, the end of his story. So, Alex went from the prospective buyer to ownership. So, let's unpack the deal. So, Alex found a regional HVAC company that was a perfect fit for his target buy box. He positioned it as a win-win, emphasizing continuity for employees, growth, and the opportunity for the seller's legacy to continue, indefinitely. Alex found this local HVAC company. He secured the LOI. He hired a competent deal team. There was due diligence came back clean, and 6 months later, Alex became this new business owner. The deal closed smoothly. Employees stayed on board, and Alex is a proud new owner of this regional HVAC company. The lesson is simple. Success in acquisitions, it's not about how long it takes or the speed. It is about positioning yourself to do the right things, go through the process correctly, and reduce risk throughout the way to make sure you're buying a great business at a fair price. So Alex is just one of many of the successful business operators I've had the pleasure of working with. His story inspires confidence in the acquisition space, in my opinion, and he's an exceptional owner in his outright, in his own right. So I checked back in with a few more of my previous clients, and I asked them for some advice. What are some advice from current owners? I asked them if you could go back and tell your old self any one piece of advice, what would you say? Uh, One owner of a commercial millwork business said, if I could go back to the start of my business search, I'd tell myself to focus on building relationships early, network with brokers and other owners, because that relationship building made all the difference in finding the right deal. An owner of a manufacturing company said, the one piece of advice I'd give myself at the start is don't rush through the process. Take time to thoroughly understand the numbers and the business operations before committing. And the owner of an HVAC company said, looking back, I'd remind myself to be persistent. Stay in your buy box, be disciplined in the types of businesses you'd like to purchase, and keep showing up every day. The right deal will come, but it's important to stay patient and not get discouraged by early setbacks. So I love these three quotes, and I am grateful of their contributions and some of their perspectives because there are three different ideas I'd like to leave you with. Being persistent and staying narrow in your buy box is very important. Another common attribute I see with searchers who have been looking for businesses for multiple years, et cetera, is they will begin to broaden their deal buy box and they will pursue businesses that might be smaller or larger than they were originally intending to buy. This causes a number of challenges. So I would encourage you to be disciplined and stay true to your buy box because the right deal will come if you just keep showing up. The manufacturing piece was taking time to thoroughly understand the numbers and the business operations before committing is a great piece of advice. You can hire a competent deal team, you can hire the best accountants, lawyers, etc. But if you don't take the time to understand the numbers and the business operations, uh, you're setting yourself up for failure. Ultimately, you are signing that personal guarantee if you're using an SBA loan. So you need to conduct some level of business analysis on a financial and operational standpoint in conjunction with your deal team. And then lastly, networking and putting yourself out there early in the process. This ties back to stop planning and start doing. Network with brokers, go to searcher meetups. This will begin to broaden your network. And the more people you tell about, you're interested in buying a business, crazy things have happened. I probably have worked with a few dozen new business owners who have said they found their businesses from a friend of a friend who heard they were looking for a business. Um, these sort of stories happen because they put themselves out there. So building that network early on in the process can make all the difference.